Another 30 days late. LTV 95, LTV 90. They caught up on their
60 days late. Jesus, when is LTV 110? I've never heard of that.
30 days late rated adjusts. 7 rated adjusts. 6 rated LTV 95. Jesus.
You likely know Michael Burry as the hedge fund manager featured in The Big Short movie, played by Christian Bale. Burry gained recognition by making bold, calculated moves like shorting the housing market and earning $100 million for himself and $700 million for his investors through credit default swaps. So, how did Burry predict the huge housing crisis before almost all the Wall Street hotshots? Let's take an inside look at the simple rules that guide Burry's game-changing market decisions.
I called up the prospectuses and I read the prospectuses and I looked at these pools. I could see the credit standards within these pools deteriorating just quarter to quarter.
How could you tell that?
There was essentially crappier mortgages being put into these pools, and it didn't seem investors seemed to care, and it didn't seem the ratings agencies seemed to care.
When regular investors were going crazy over internet stocks in the 1990s dot-com boom, Burry focused on regular companies without a lot of hype that were still making solid profits. So the question is, how does Michael Burry evaluate his investments? When looking at possible investments, Burry does very detailed financial research. He hunts for good companies that most other investors are ignoring or have the wrong idea about, driving most of Burry's big winners. For example, by really digging into the shaky finances behind mortgage bonds, he saw problems in housing way before Wall Street. Burry has a talent for spotting risks that everyone else is missing when prices get out of whack. It takes patience and an independent view, but for Burry, finding mistakes creates huge opportunities.
The housing market is propped up on these bad loans. It's a time bomb, and I want to short it.
Through what instrument, Michael? There are no insurance contracts or options for mortgage bonds. The bonds are too stable.
Lawrence, this is what I'm going to do. I am going to get a bank to make me one. And then I'm going to buy it.
While no investment strategy works 100% of the time, some of Michael Burry's most famous contrarian stock picks include investing in GameStop in 2019 at $3.56 per share, buying over 3 million shares. By 2021, this just over $10 million skyrocketed to over $271 million as the video game retailer became a meme stock darling. Even when others are fearful, Burry stays calm and sticks to his own analysis. While day-to-day stock moves don't matter much to him, Burry thinks long-term about earnings potential years ahead. Looking at where industries are heading is key in his view. His farms and water investments, for example, show this big picture perspective, which we will get to in just a moment. At the same time, Burry is very careful about balancing risk and reward. His specialized use of credit default swaps in 2008 shows his calculated thinking. Limit risk, but keep potential gains open. Burry gets that markets are volatile and keeps risks in focus. Now, Burry has a number of core investment rules that we could potentially follow. Value investing is at the heart of Burry's style, finding overlooked stocks trading cheap compared to what he sees as their real long-term value. But careful risk management also balances possible gains versus losses. Burry knows balancing risk and reward is key in investing. Gains don't come free. For example, when positioning short against housing, he initially took a very small position. Burry slowly increased his trade to $1.3 billion as more evidence appeared, minimizing early money at risk. No matter the investment type, he carefully sizes each trade based on his risk assessment. Rather than rely on Wall Street research reports, Burry does his own deep analysis to guide his decisions. Ignoring market noise and short-term arguments keeps his focus on reality. Burry wants a stock's price to be far under what he calculates as fair value. This gap acts as a cushion in case surprises pop up. Burry steers clear of overhyped stocks lacking strong fundamentals. He focuses on companies with real value and concrete financials, not those with flashy stories fueled by speculation. We've talked about Burry's early stake in GameStop that later skyrocketed in value. Now let's look at other examples showing his unique style. Burry's most famous trade involved shorting the overvalued housing bubble before the 2008 crash. By selling mortgage assets he didn't own, planning then to repurchase later at lower costs, Burry profited enormously when housing collapsed. His digging into mortgage data to identify problems and willingness to make a contrarian call, quite frankly, sets him apart. The key factors that led to the movie. After 2008, Burry started investing more in smaller Japanese companies that most investors, especially foreign ones, tended to overlook. Even though the Japanese stock market has been struggling for years, Burry saw recovery potential ahead. One of Burry's most unique plays has involved investing in water-related assets. He recognizes that water would become more scarce and valuable over time as populations grew. So he invested in farms loaded with water access and companies focused on water utilities. For example, he bought almond farms in drought-prone California, calculating that his water-rich properties would thrive as the resource becomes more precious. But you can't win them all. Burry bought shares of Taylor Brands, for example, the company behind Men's Warehouse. In 2018, he was expecting a turnaround, but the stock kept descending as Taylor Brands faced heavy losses in 2020 due to COVID, which severely impacted clothing retail. And in August 2020, the company filed for Chapter 11 bankruptcy protection as it couldn't pay its debt. So, Burry's investment resulted in a 100% loss. The shares became worthless when Taylor Brands declared bankruptcy. Now, this demonstrates that even leading investors like Burry make poor decisions on occasion, emphasizing why diversifying across multiple investments is crucial for everyone. Now, in the technology arena, Burry made large investments in Google and Facebook back in 2018 as well. Though the exact returns are unknown, the move aligned with his strategy of investing in companies with strong track records alongside future potential. Tech has kept evolving at lightning speed since then, and the price has gone up with it. So, Burry likely saw really good upside. Lately, Michael Burry has been making warnings about what he calls risky markets, which we'll get to in just a moment. But where has he invested his money that he believes can perform despite challenges ahead? Well, let's look at his top positions for clues. His largest investment by far is automaker Stellantis, allocating nearly 20% of his portfolio here. This giant company formed in 2021 when Fiat, Chrysler and Peugeot merged together. With high gas prices and more electric vehicles coming, Burry made a major investment based on his analysis that car sales will keep going strong. His next major investment is Nexstar Media Group, the largest owner of local US television stations. Perhaps Burry believes local news and entertainment maintains an audience despite streaming gains. Political advertising money for the elections probably helps profits too in the short term. Nearly 20% of Burry's portfolio went towards Chinese online shopping giants Alibaba and JD.com. Now, despite China's economic struggles lately, Burry believes these vital e-commerce firms remain essential and emerge healthier, long-term classic contrarian stance. Finally, Burry holds office space investment trust Hudson Pacific. I'm really surprised by this, because remote work is draining many offices, but he thinks that premium spots in coastal cities near big tech can cope better, in his point of view, so he focuses investment on those locations. Well, Michael Burry has an ability to spot the next big tech winners early, like investing in Google before it was huge in the mid-2000s, but now he's warning investors about crypto and AI getting overhyped. Burry thinks that recent crypto craze and AI marketing hype have created speculative bubbles similar to the dot-com years in the 90s. So for example, after the stunning collapse of the $32 billion crypto exchange FTX in late 2022 due to risky leverage and lending exposures, Burry noted issues around lack of accountability and absurd valuations detached from reality in crypto markets. He feels that Bitcoin, blockchain, and AI systems are still unproven and overvalued despite big promises. Now, we have obviously done extremely well investing heavily in cryptos, and I have personally made millions already on crypto wins and expect my portfolio to continue skyrocketing. However, Burry's talent for finding good tech bargains after past bubbles pop suggests he may take advantage if crypto AI fall back down from unsustainable levels due to weakened speculation. Since he has identified promising tech companies when value drops after hype fades, Burry could invest profitably again if crypto or AI hype customers begin losing faith, which personally I don't see happening. His history of targeting overlooked tech ventures when a frenzy ends may benefit him once more. While risk management is crucial in investing, we would argue that assets like cryptocurrencies and AI stocks still have major potential if invested strategically. Unlike Burry, we remain very bullish on the prospect of crypto transforming finance and AI driving growth. Personally, I believe anything without a solid strategy carries risk. By taking a diversified approach, following the data, and sticking to budgets, cryptocurrencies and AI can thrive in a portfolio. We've seen firsthand how cryptos can deliver outsized returns, and AI feels inevitable given rapid tech shifts. However, no investor gets it right all the time. For the last few months, Burry made multiple short positions based on his prediction that the stock market would crash in 2024. For example, he spent millions paying for options that profit if the S&P 500 and Tesla shares sink lower. But later in a tweet, Burry said no one knows when these things will unravel, just that they will. So, although famous warnings can give caution, even skillful investors cannot always predict the timing of crashes accurately. In fact, nobody can. Instead, it's better for individuals to spread investments across assets, risk levels, and timeframes. That way, your portfolio stays protected whenever the next market drop lands. So, what's the most important investing lesson you learned from Michael Burry? Comment below and let us know.